Some weekends, you see a project open its doors and units disappear faster than a Black Friday sale. Other weekends, another launch barely clears a quarter of its inventory. So, what's really going on? Because if you only look at the headlines, the Singapore property market looks like a roller coaster. But when you study the data, the surveys, the sentiment, you start to see a pattern. A pattern that is both powerful and dangerously misunderstood. Today, we're going to break it down. Let's talk figures. In October 2025, new home launches, excluding executive condominiums, sold 2,424 units. That's about 9 times the volume of the previous month and 224% higher than the same month a year ago. Analysts now expect full-year 2025 sales to hit 11,000 units, excluding ECs, well above earlier estimates of 7,000 to 9,000. Over 50.5% of those October sales took place in the rest of Central Region, RCR. So yes, momentum is very real. At the same time, a survey by National University of Singapore's IRIAS shows households' mortgage balances grew by 5.2% year-on-year in Q2, the fastest rise in 6 consecutive quarters. Homes are being bought, debt is rising, buyers are back, but, and this is critical, the momentum is selective. Here's a cautionary tale. The Sen, a 99-year leasehold in Upper Bukit Timah, launched with 347 units. Over the launch weekend, it sold 80 units, about 23% of the total, at an average price of 2,358 PSF. In the same RCR market, new non-landed homes averaged about 2,770 PSF up to early November. So what's happening? Why is a project in a relatively strong locale below average pricing still only managed 23% take-up on day one? Hence, we can see that buyers are not just buying on hype, they're more cautious. The launch frenzy is being reserved for the best product market fit. In other words, the market is rewarding selectivity. And that means 2 things. Great projects will still move fast. Projects without the full alignment of location, pricing, layout, exit potential will face resistance, even in a strong market. Now, why is demand strong? You see, interest rates are lower, income stable, housing finance easier. Developers themselves say low unemployment, steady household income, and lower financing costs are the cause. Yet here's the caution. The same IRIAS survey shows 85% of real estate players expect new home loan take-ups to rise, and around 60% flag new cooling measures as a top concern. This is the hidden risk. You may be buying in a heated market, but you're also doing so in a leveraged market with more debt in the system and policymaker attention rising. If interest rates tick up or if lending rules tighten, this demand may falter faster than many expect. Also, the supply is moderate. The launch calendar remains active. Analysts estimate more launches in early 2026. So the classic short supply narrative doesn't fully apply. Rather, good supply is available, but the market is differentiating based on quality. Hence again, better product sells, average product lingers. Here's the moment to lean in. Take note of the top risks flagged by industry. Economic slowdown, job losses. Survey says this is the #1 concern. Flood of housing loans and rising household debt. New cooling measures, especially debt-based. Rising construction, labor costs squeezing developer margins. Look, when these risks crystallize, they usually hit the weaker projects first. So if you're buying now, your margin for error is narrowing. Here's what you need to take away. Yes, the market is strong. October proved that. Units sold, demand returned, pricing held. But we're not in a blind surge. We're in a refined surge, where only the right project fits the formula. And behind that excitement lurks liability, higher debt, higher expectations, higher policy risk. If you're a buyer today, focus on exit liquidity, not just snap up the launch. Project price, builder, and exit strategies must align. Be conservative with your financing. Be realistic about rates rising. If you're a seller, now may be the sweet spot. But don't wait for euphoria, because when the risk triggers hit, For many, it will come as a slow-moving fade, not a crash. If you're an investor or developer, yes, you can ride this wave, but only with the right moat: location, design, future resale, product clarity. And keep one eye on your cost base and policy horizon. The headline says momentum. The fine print tells a more nuanced story. The new home market in Singapore today is alive, but also choosy. It rewards excellence and penalizes the rest. Watch the dashboard, because once the warning lights flash, the smooth highway can become a narrow road. If you like this market update, please like, share, and subscribe. Visit SingaporePropertyLens.com to uncover blind spots on your next purchase. My name is PK So, and I look forward to serving you in your real estate needs. Take care.